if you, instead of taking all of your money in distributions from QYLD, what if you reinvested portions of that money? What worked out well? What helped some capital appreciation? And so that's what we're going to try to figure out in this video. What's up, everyone? My name's Robbie. This is Robbie in Manila. And today we are exposing QYLD. So maybe you've watched my video on the best yielding ETFs, and in that video on my top 3 yielding ETFs, I included QYLD. If you're not familiar with QYLD, it's the Global X NASDAQ 100 Covered Call ETF. QYLD distributes money monthly, and they can range from 0.8% per month to 1% or even more per month. This has resulted in a 12-month trailing dividend yield of over 12%. So if you had invested $100,000 in QYLD, then every month over the past 12 months, you would have made probably on average more than $1,000 of income. And so this is great, and it's a great yield, and a lot of people can benefit from this ETF. However, there are some things that I think everyone needs to know about. So the problem with QYLD is the lack of potential capital appreciation. If we look at this chart here, this shows the performance and growth of $10,000 invested in QYLD since the inception of the fund. And you'll see this blue line is QYLD's growth. And so this chart looks great, and I think a lot of people look at QYLD and they think that this is going to happen to them, but the problem is this is a total return chart. This chart is showing all of the income that comes off of QYLD being reinvested back into the fund. So you might think that this is going to happen to your fund, but really this is the price appreciation or depreciation of QYLD since inception. And you'll see if you had invested in QYLD at $24.96, it's only worth $22.52 now, and that's from 2014 until today. And now think of what happened in the NASDAQ 100 over this time period. It had a crazy return, yet QYLD lost almost 10%. And you can see here the actual loss is 9.99% over this time period. And so this next chart actually shows QYLD versus the index that it writes covered calls on, so the NASDAQ 100. Look at how big of a difference there is in the just total price appreciation of the NASDAQ 100 being 337.62% since inception of QYLD, while QYLD lost 10%. Now remember, QYLD is not reinvesting dividends in this thing. It's not reinvesting income. It's showing that it's distributing all income to the investor, but still, that is a huge price difference. And so the question is, while this thing has done so well, this NASDAQ 100 index, yet QYLD has done so poorly, what if the NASDAQ 100 had a terrible time span of a few years? Like, what would happen to QYLD? And that's the question that I don't think I'm confident with having all of my money distributed from QYLD. And so what I did was I went and looked at some different variations of what might happen if you, instead of taking all of your money in distributions from QYLD, what if you reinvested portions of that money? What worked out well? What helped some capital appreciation? And so that's what we're going to try to figure out in this video. So let's take a look at this next slide, which actually shows my favorite dividend ETF, which is SCHD, just to kind of show you that dividend ETFs don't always have to lose value when you take money, the distributions out. SCHD, on a price appreciation, not investing dividends, also grew 200%. So SCHD yields a lot less than QYLD, maybe around 3% instead of 12%. But still, it had decent capital appreciation while QYLD didn't. So comparing SCHD to QYLD on just a price appreciation, again, not reinvesting the yield that comes off of these funds, it shows that SCHD had over a 200% return over that time period, while QYLD again had almost a negative 10% return. So what I did was say, okay, QYLD yields a lot of money, right? So 12% or so. So what if you didn't take 12% out of QYLD? What if you only took a portion of your money out? Let's say, what if you reinvested 20% and you only distributed 80% of your yield? You're still going to get a nice amount of monthly income, if you're using it for retirement or whatever reason you're using it for, you're still going to get good yield. But you're going to be able to reinvest some money so that you don't quite lose that capital appreciation, especially if something happens to the NASDAQ 100 going forward. And I don't know, maybe QYLD won't have such losses, but I'm not sure and I'm not confident in having my money in something that really is lacking any capital appreciation in a time when there has been a crazy bull market. So what I did was export all of the data for QYLD since inception, essentially, on a monthly basis. I took all the distributions and the price appreciation or the price changes during those times, and I said, what if you, instead of distributing all of your money, what if you actually reinvested some money and bought more QYLD? So this is actually the result of not investing any money. So let's familiarize ourselves with this graph real quick so we understand. This little dot is basically saying if you had invested $400,000 in QYLD, this line here is your price depreciation. So this is what you lost. This here is the end of year value. So 400,000 invested by 2014 went down to 375, 364, okay? So, and it's currently in today's dollars would be around $357,000. Over the time, of course, these distributions annually have been coming off, right? So that's great. And so this is the same thing just in this one. It changes in the next one, so don't worry about that. And so what I decided was that I wanted to figure out how much would be like an adequate amount that I feel comfortable with distributing out of QYLD while reinvesting what portion as well. So what I did was I first started with 20%. So what if I distributed 80% of QYLD but I left 20% in? And so this is what it looks like, the same exact situation I showed you before, but you're reinvesting back into QYLD. This is what it looks like. So end of year value is going to be a lot higher, $410,000, starting with 400. So that actually means you gain 10% over the time period. It's not a lot, but you did not lose 10%. So you actually had some capital appreciation still, which I find good. Of course, you still had years where you had some big losses. So again, to me, I think that it's very important that you still have a bit of capital appreciation in this thing, because I don't think the future is necessarily going to be as good for the NASDAQ 100 as it's been. So then we'll go here. So this is going to show reinvesting 50% into QYLD and distributing 50%. And this is how I would prefer to have something like this. I don't think, for me at least, in my opinion, I don't think having QYLD and distributing all of the income from it is a safe thing to do. I would not want to do it for my own money. What I'd want to do is I would want to distribute some and then reinvest some, of course, and this to me actually looks okay. So I would be okay with this, which is investing the same $400,000 into QYLD, and look at what happens. This thing almost grows in every single year. There is one down year, and then it recovers. So in 2018, that was the only year that this thing lost money. End of year value. Actually, the end of the year value in the first year did lose 5,000. But then it went up back to 4, to 405, 462, 419, 492, and then 504. And then sitting at 504 today, it's gained $100,000, and you're still getting decent yield, which is something that I think is great. So here, you would be distributing the yield of $20,000, and then you reinvest $20,000. Same here, and so it increases, and there you go. So you're distributing, you're getting about $25,000 still in distributions, and you're reinvesting, $27,000 back into it. And to me, that's definitely fine. So get about a 6% yield, also getting that 100,000 gain over this time period. I would prefer that. And that way I don't feel as bad and as scared if a longer term bear market shows its head. I think I'll be a lot better in something like this than distributing all the money from QYLD. So that's all I have for the video. I hope this helps. Maybe you disagree with me, maybe you don't. I hope that maybe some ideas rolling in your head at the very least. And but if you did like this, like the video. If not, let me know. Tell me what you think if you don't agree with me. I'd love to hear from you actually in the comments in general. And watch another one of my videos coming up, please, on the end screen right now.